Right, Chapter 5 is Sarbanes-Oxley, Internal Control and CAT. So let's jump right into the Sarbanes-Oxley Act and its impact on... So the Sarbanes-Oxley Act was an act passed by Congress in wake of the big accounting scandals. So you had your Enron, MCI WorldCom, Waste Management, and Tyco, and all of those I'm sure we've all read about. If not, probably be a good thing to go check out. So what was happening is that places like Enron, Tyco, and WorldCom, there was fraud, there was theft. And what was happening is that fraud and theft was deceiving stockholders and investors and creditors, and people were losing a lot of money when these scandals came out. So that gave Congress the action to act, and they passed what's called the Sarbanes-Oxley Act. Conceptually, what the Sarbanes-Oxley Act was supposed to do is provide better internal controls over the business, so better checks and balances, so that way that the fraud and the theft would be caught. And that means stockholders, investors, and creditors would have better information to have better information. So this idea of internal control, so the objectives, one of them would be safeguarding your assets. So that would be keeping your money in a safe. If you run a retail store, have the guy at the front of the store as a loss prevention person to make sure that when people leave the store, they have a receipt. Accurate information. So that means that what's on the income statement, the balance sheet, the statement of cash flows, retained earnings statement, all of that is good information. There's no fraud, there's no misstatements, everything's good. And also compliance with laws and regulations. So compliance with GAAP and other regulations. So there's multiple elements to internal control. So we have our control environment, our risk assessment, control procedures, monitoring, and information and communication. So the control environment is the overall attitude of management and the employees about the importance of the controls. So the management's philosophy, the organizational structure, the personnel policies, that's the environment. Well, risk assessment is that management identifying risk, analyzing the importance and what they're going to do to assess risks to businesses. So that would mean if you run a business in Florida, that you know that there's a risk of a hurricane coming through, to make sure that you have a contingency plan. You have a disaster recovery system to back up all your IT data. Things like that, risk assessment. Control procedures is one of the more important elements. So that would be having rotating duties, competent personnel, separating responsibilities. That would be like separation of duties. So the guy who receives the inventory in the warehouse shouldn't be the one ordering it and writing the check to pay for it. So it would be things like that. And then monitoring would actually be having a system to be able to find weaknesses in your internal controls. So one thing that companies do is observe employees' behavior in the accounting system. So what you can do is look at the accounting system and find out what people are actually doing within it, and see if things are being done wrong, things are being done fraudulently. It's actually checking on these things to see what happens. And then information and communication is being able to use the information you have about the other elements to make decisions, and to make sure that you're in compliance with legal regulatory things. So kind of diving into all of those a little bit more. So the control environment would be management's philosophy and operating style. So if you have a management style that's very lax, nobody pays attention to what anybody's doing, it's kind of a country club setting, well, that's not the best control environment, because that's where if it gets too loose, people feel comfortable to steal or do fraudulent things. The company's organizational structure. If you have an organizational structure where you have everybody's a manager and everybody has access to everything and very few employees, well, you don't really have a top-down view because everybody's kind of already at the top. And then personnel policies, I mean, if you hire people that aren't competent, mistakes are going to happen. So risk assessment is to identify risks so you can take steps to control them. So that would be like if you run your business in Florida, you have a contingency plan in case a hurricane comes. So control procedures, pretty important. So a few examples of that, and this goes way beyond this if you want to read about it, but competent personnel, rotating duties, and mandatory vacations. So, competent personnel, if you have better people, mistakes are less likely to happen. Rotating job duties, where if you have the same person doing the same job for so long, they get too comfortable and maybe become less competent or find holes in the system. In mandatory vacations, that's important because you want people to have a good morale. When people have a bad morale, they're more likely to do bad things. And separating responsibilities for related operations. So look at an example here. You have a guy who receives the inventory at the warehouse, but he's also the person that pays for that inventory. He also gets to cut the check, and he also makes the order. What's wrong with that? Well, he can order something from a manufacturer, use the company's money to pay for it, say he received it at the company's warehouse, but actually ship it to his house, and nobody would be there to know. And separating operations, custody of assets, and accounting. So what that would mean is that the person who receives a check in a company shouldn't be the person who records it in the accounting records. That way, a person can't receive the check, sign it on the company's behalf, and then put it in their personal bank account. And then proofs and security measures would be simply locking things up, having passwords, things of that nature. So monitoring would be to locate the weaknesses and improve control effectiveness. So that would be like, for instance, doing internal auditing within a company to test controls, see how well access controls are working. See how well your purchasing process works to make sure that people aren't all doing the same job. So it's keeping an eye on it and finding ways to make things better. Then information and communication is kind of the link between all of these. It's taking all the information from your control environment, your monitoring, your control procedures, taking all of that and being able to communicate it downwards to everybody in the company to get everybody on the same page. There are some limitations of the internal controls we just talked about, though. I mean, one big one is the human element. You can't predict what people are going to do. You can train people, you can get competent people, but in the end, they're going to ultimately do what they want to do. And then there's a cost benefit of a system, too. You can have the best system in the world on your IT side, on the accounting side, but there comes a point where it costs a lot of money to implement it and it costs a lot of money to maintain it. So you have to figure where the best cost benefit is for your particular situation.